interviewing the leading private equity executives and unlocking the secrets of success. Welcome to the Private Equity Podcast with Alex Rawlings.
Hello all. Joining us today is Greg Gille from Unquote. Greg is an editor and is chair of the judging panel for the British Private Equity Awards. So welcome and thank you very much, Greg, for joining us and sharing your insights into the private equity industry.
Hi, Alex. No worries at all. Pleasure to be here.
Excellent. So, Greg, for those who don't know you, please give us a 60 to 90-second breakdown of you.
No worries. So my name is Greg Gille. I am mainly the editor of Unquote, Unquote being a European private equity publication that focuses on the market across Europe from a data point of view, from an intelligence, i.e. news point of view, but also analysis, kind of features, looking at trends, etc. We also do a number of events, as is quite usual in that corner of the trade press, and we do podcasts, videos, etc. Plus, as you mentioned, the yearly British Private Equity Awards. So I'm the editor of the publication, meaning I oversee the team of journalists that will gather our content and come up with all these analysis pieces and all that proprietary intelligence on what's going on in the private equity market. And on the award side, I am both a judge and chairing the panel of judges for the awards. On top of that, obviously doing a number of podcasts and videos. And when we used to do conferences, in pre-COVID days, chairing a panel or two as well. So that would be me in a nutshell.
Excellent. So just thinking about that with the private equity awards, are you guys doing that remotely? Is that another Zoom type
we used to do it in person, so to speak. So both the judging panel would take place, we'd all get together in a room, but also the ceremony itself, which was great. It's great fun, black tie dinner and lots of fun usually being had, and it's really good atmosphere. It's quite relaxed. Obviously, last year was a little bit different. So we did it virtually, not really from a kind of a video perspective or, webinar perspective, but we put together a really kind of cool website that's animated where you had to scroll to reveal the winners, trying to replicate that kind of sense of anticipation a little bit. And it came through in the end. I think people were quite happy, obviously, knowing that we just couldn't do what we usually do, which is cram 400 people in a ballroom somewhere, sadly. But we'll get back to that, I'm sure.
It'd be a bit, it'd have to be a big room, and then, well, to be fair, we wouldn't be allowed to do it right now anyway, regardless. So as the world keeps ever changing, but we plow on through. So I know, Greg, from our previous discussions that you're actually originally from France, and hence the Gille surname there. So, but obviously your time, I think 10 years plus in the UK, has somewhat diminished your French accent, and there's a little bit of it hinting through. I know, I sense that when we spoke.
French listeners will have picked it up from the first few seconds, but
absolutely. But for the untrained ear, you will obviously have lost that to some of us. But interesting to always see the diversity that's both based in London, but also across Europe, with London being a major hub, but also Paris, of course, Milan now growing, and Munich being major private equity hubs, as well as others. Not to miss them out. So keen to hear about this judging on the private equity awards. So from what you've seen, obviously from both recently and previous years, what are you seeing private equity firms kind of doing right and excelling in?
Yeah, so I mean, it tends to depend on the category we're looking at, right? So if we look at the awards that we do, we'll have a number of quite specific awards for a specific transaction, usually an exit. We usually judge at the point of exit because the proof of the pudding and all that, but also for a specific fund. Beyond that, there tend to be kind of overall awards. So if we look at, mid-market buyout house of the year, that encompasses a number of things from, deal doing activity, fundraising activity, communication with LPs, a number of different things. Same for the Responsible Investor Awards and that sort of thing, and same for the advisors as well. So we don't only judge GPs, we also judge advisors based on their activity, but also based on a few kind of qualitative case studies. So the answer to that question, ultimately what makes a firm successful, it tends to depend a little bit. If we're looking at purely one transaction, then what we tend to look at, because I think ultimately that's what the industry would look at, that's what LPs would look at, is pure performance, and there's no getting away from that. Obviously, we can go a little bit deeper, especially when, let's say, we're looking at a couple of entries that are quite close in terms of what overall the return was on that investment. We can look a little bit deeper, and we actually ask a number of questions around how that value was created. And we'll look at, I think if you look at a deal that was, bought at the right time, fairly low multiple, quick flip a couple of years later because, approached by a US trade buyer, and it works out well. And, through multiple arbitrage, maybe a little bit of, leverage play, it ends up being quite a high multiple, especially a very high IRR given the short duration of the investment. And on the other side, you've got something that, they've been working really hard on for years and years. Lots of bolt-ons and maybe reorganizing the business, bringing in new talent, really getting in there and making operational changes. That's something that the judges will look on very, very favorably. Not saying that the first example that I gave was irrelevant. It is success. It's ultimately what do we look at is LPs investing in the fund. They want to see a nice profit on that, and they certainly got that in the first instance. But especially when it comes to the other one that we'll look at, and that tends to be more for the overall categories, right? So if we look at the house of the year, be it venture or buyout or whatever, consistency is really important, right? And I think as an industry, it's something that private equity can be quite proud of. Certainly the top performers there is being able to consistently apply your model, which, it needs to be differentiated in the first place. You need to have a number of other kind of drivers of success. And I'm sure we'll talk about that a little bit later. But ultimately, it can't just be a one-off, can't just be like that one massive exit and you sort of ride on that for years and years, or, even that sort of super successful fundraise, people will be impressed by that to a point, but you need to show consistency throughout the years, I think, and being able to show that you can repeat that. It's not just luck. You create your luck to some extent. There is an element of luck involved as well, but that factor of consistency is very important. And our judges, they all come from different corners of the industry, so they'll look at slightly a different lens when they look at success, what success looks like. And they know these firms well, especially when they've been in the market for quite some time. And they will always, even when it comes to that, the house of the year category, we look at what's their most recent 12 months been like, how many investments, have they raised a fund. But judges will always kind of go back to, these guys, not only have they had that great year, but also we know they've been doing that consistently for years and years. And that's very important. And ultimately that's what, because we award awards, which is great. People are very happy to receive an awards, and it's I think we've been doing it for a long time, and they're well respected in the industry. But ultimately, what people, especially on the GP side, what they want is to get more commitments from LPs on their next fund. What advisors will want is to just win more mandates and work with more private equity firms on bigger deals and more deals. And if you haven't got that consistency of performance, it's just not going to happen. So I think that's the two key bits that we look out there, stand out deal by deal, fund by fund kind of achievements, but also an element of consistency over time. Sorry, that was a very long and rambling answer to No,
that's all good stuff. You spoke a lot. There's a term used a lot at the moment within private equity, and I do find that these terms go through cycles and we rename them and they come under something else and then reappear multiple years down the line. Value creation is an area that's getting talked about a lot and obviously that's what drives, evidently the end play, which any private equity is looking to do in their liquidity event. But what areas of value? You mentioned the value creation part. You mentioned that top line, the liquidity event, the exit multiple, or IRR results. What do you look for actually in the value creation side? And is there anything you've seen that's been particularly impressive?
Yeah, I think, the pure, what we'll always impress, we could always do a hierarchy, but ultimately it's all, we shouldn't really compare it that way because, as I said, LPs will look at the final result, right? But that said, again, if we take a couple of examples, maybe, again, let's look at 3 different examples because that might make it a little bit easier. The first one, which is kind of similar to what I mentioned earlier, ultimately the value creation is mostly driven through either financial engineering or, good timing of the market, good multiple arbitrage. Nothing wrong with that, obviously. And that can lead to very, very good return, especially from an IR perspective, which allows LPs to kind of recycle that capital fairly efficiently. So that's one. The next one would be that kind of the buy and build play. And, I'm sure we can talk about that some more later as well. That's obviously a big theme in private equity at the moment, given what the market has been like for years now. It's not just, last year with COVID. It's not just because of Brexit. In general, unless you're really targeting very specific niches of a specific industry, you can't really rely on crazy growth, organic growth for the businesses you're going to target. Buy and build has been a major play for a number of private equity firms for very obvious reasons. And that's, it's obviously hard work as well because you've got to, first of all, find the right platform. And then you've got to spend a lot of time identifying opportunities, doing these deals, depending on how hands-on you want to be as well. Is it just, are you quite confident that the management team can sort of handle that fairly well? Do you need to step in? Do you need to do a lot of help from the origination point of view, the execution point of view? And that's, perhaps something that we can talk about when we mention things that work less well sometimes for private equity from an integration point of view, right? So that's, that can lead to significant value creation. And it's obviously a lever that they will use in most cases. Some firms obviously specialize in that, but even those that don't, the element of buy and build is always a strong one for a number of firms. And then you've got the pure kind of operational, let's roll our sleeves up and get in there. And I'm not just talking about, the obvious example would be turnaround players or that kind of slightly distressed, slightly let's focus on corporate spin out and turn these into standalone businesses. The value creation there is very evident, and it comes through a lot of hard work and a lot of time spent with the company and really knowing the ins and outs from an operational point of view, but also usually the way that it tends to work very well is when you marry that to a sector expertise as well, and you come in and you're able to, as a GP, you're able to really bring in that extra level of expertise on top of just helping on the operational side of things. So you've got 3 kind of value creation routes there, and most of the time it's never really that clear cut. There's going to be a little bit of an element of everything. But if we're talking about archetypes, I think what will really impress most everyone, in the market, LPs, us, the press, judges, whatever, even your peers as a GP, is that probably the third one, which is that ability to understand what the business needs, what it needs to grow, helping it get there, and really making that work, which, and obviously it works slightly differently depending on the segment of the market that you target, right? Large cap buyouts, probably, not the way that you're going to drive, most of your value creation there, probably more, bit more financial engineering, a bit more gearing, a bit more buy and build consolidation strategy at play there, although there is still, organic growth possible. But in terms of that transformative aspect, and I think that's the word I should have mentioned maybe earlier, is that transformative impact that private equity can have when people can display that. And again, not just on one deal, but as a strategy repeatedly with the track record of doing that, that tends to be very, very impressive.
Absolutely. And looking at so you mentioned obviously what we're seeing, a lot of that value creation piece and what's going right. What do you see maybe as cumulative areas that maybe private equity firms are struggling with, or maybe not doing as well? What areas are you kind of seeing within your assessments of contenders for your awards?
We're a little bit, especially when it comes to the awards, it's a little bit tilted because we also tend to the awards work on a self-nomination basis. People have to submit entries because we're after more than just the pure numbers. We want to know how they got there. We want to have some qualitative kind of insight as to what went on there. We kind of rely on them filling out that massive entry form, which is about 1,000 words, when they really are going to. So, they're usually not going to go through the effort if it wasn't a good deal to start with. So we're usually starting from quite a high base. So we don't really see, really horror shows and terrible examples of things that went wrong. But that said, obviously we, from the editorial point of view, we've been covering the industry for a long time. So I think we've got ideas as to what's going on there. I mean, the very obvious one is the sort of the overgearing element, the overstretching element when it comes to the financial, and just being just a little bit too aggressive at entry, especially when you combine that, which I think, I was quite tempted actually when you mentioned that point earlier, to first, overpaying is obviously the one that will be on everyone's mind, and would be the kind of prime example of, whoa, be careful what you're doing there, private equity as a whole, because we've seen multiples kind of rising, and then you arrive at a situation like we had in the past 12 months where all of a sudden the market completely, is flipped upside down, and that leads to, especially in the first few months, not so much now, but especially in the first few months, that massive, what do we do? Because we've been, as an industry, we've been doing deals for close to 5 years now with really, really punchy multiples. From a historical point of view, what happens when the prospects suddenly look very, very different, and maybe we can't exit for a couple of years, or the business is just put under tremendous pressure. At the moment, to be honest, it's obviously something that we'll keep an eye on, because it might start. It's hard to tell in the performance, basically, especially at fund level, if we're talking about investments that have been made in the past 5 years or so. So we'll have to see about that, but that factors into that sort of if on top of that you've also kind of overgeared the business to start with, that usually when mistakes tend to get made. The second one is I think stretching out too much, and that's more not necessarily from a deal by deal perspective, what makes a deal go wrong, or what makes it not work too well, but more as a firm, when we've seen people struggling a little bit, and the prism through which we see GPs struggling, especially us at Unquote, given our focus on more the kind of LP-GP relationship and fundraising, is fundraising is the firms that end up with really overstretched fundraising processes that just can't cross the finish line, or end up not raising a follow-up fund at all. That's the ultimately that's the death for private equity, isn't it? You just need to raise capital. And I think what tends to happen sometimes is people just stretching out too much and going outside what worked for them in the past. And it's a really fine line, because if you ask me about what makes, again, a successful private equity firm, as opposed to just a successful deal or something like that, the ability to innovate and to push yourself and to go into new areas is a very potent one there. But the potential for it to go wrong can be quite should always be on the back of the minds of people, and especially when it goes to credit is super hot at the moment, let's raise a credit fund, or that's the kind of stuff that sometimes tends to happen. But that's a fairly extreme example, because it would be quite rare that people would just out of the blue, without prior experience just to launch that sort of strategy. But one that tends to happen fairly often is just like pushing the size of the fund ever upwards. And, we raised 300 million last time. Let's raise 600 million next time. And for the best performers, it can work, no problems. And that's, we've seen some tremendous examples of firms really improving and growing in the past 10 years or so, going from, pure, look at Ardian, for instance. It wasn't a small firm to start with, but if you look at the journey that Ardian, EQT, et cetera, have all been on, it's been tremendous for a slightly smaller scale, but, the living bridges and inflections in the UK when you start kind of, smaller mid-market, and then just because of their success and they've been very, very good at what they do, the AUM just shoots up massively, raise bigger funds, launch new strategies, and that's worked well. But I think we've seen examples in the past, not naming names, where that doesn't really work too well, and you end up having to scale back your ambitions when you see that you can't hit that hefty fundraising target that you had. And it's there's always going to be, ultimately that's fine, you close your fund maybe, even if it's a bit smaller, it shouldn't mean too much for your business. You can still invest, you can still do what you do best. But people will always look at that and go, stretch out too much. And I think in the eye of LPs in particular, that's something that they will probably keep in mind next time you come back for more capital.
It's one of them, isn't it? Fortune favors the brave. Until it goes wrong, and then nobody favors that. So it's a difficult one, and it all comes down to executing well. Right timing comes into that as well. And being the right place at the right time is key as well.
And just going back to, and maybe something that's a bit more applicable to awards actually, even when we're talking about something that is successful to start with. I think sometimes a tendency to, and again, it goes hand in hand with that, people overstretching in terms of strategy or in terms of fund size or however you want to look at it. Sometimes it's, chasing that flavor of the month. It can also come through in sort of chasing, hyping up ESG credentials, for instance, when it's not, when you're not doing it well, when you're just literally doing the bare minimum that you should be doing, it's maybe not worth bragging about it, and sometimes it does happen, and it's a bit, again, I think it's a very savvy industry from your peers, as in from other GPs to LPs to even advisors. People kind of see through that, so I think sometimes just knowing what you do well and sticking to that can be a good thing, and not trying to again chase that new thing. Something else that I think is kind of applicable to the award in some respect, but that's more, for me, it's more an issue with private equity in general, which sometimes the lack of transparency can be shooting themselves in the foot a little bit, especially when it comes to bemoaning the fact that the regulator, the general public, doesn't understand what private equity does, and therefore is very unfair to it. If you're a bit more transparent to start with, that can help. And that's, as an industry as a whole, the progress that's been made, having said that, is incredible. I've been at Unquote for 10 years. So just after the financial crisis, and it's nearly unrecognizable, the effort that individual firms, but mainly the industry itself, through trade bodies, etc., Invest Europe, BVCA here, AFIC, now France Invest in France, the effort they've made to be more transparent and just to explain better what it is they do has been tremendous. But there are still, some firms that I think don't quite get it, which is a bit of a shame, because ultimately, if we look at it from the industry perspective, it's very important for the industry when it comes to regulation, when it comes to, even attracting pockets of capital, like, big pension funds, public pension funds in the Nordics, in the US, that element of transparency is very important to them, and that, understanding the impact of what it is they invest in. But even from a deal-making perspective, even for smaller players, I think, the more management teams know about private equity, know how it works, are quite transparent. Obviously, the caveat to that is that firms will say, but we do that effort when we actually when we work on origination, when we meet management teams, we explain what it is we do. So yes, you can do a lot of that, but especially not so much in the UK, but it used to be the case in France, less so now. It certainly still is the case in Germany. There is still that element of private equity is the nice, nasty finance people that we don't want to sell the family business to. It's changing generationally, et cetera, et cetera. But I think everyone doing their bit to be a bit more transparent will certainly help towards that.
Yeah, I think it's an interesting one. And, if you look at a certain deal, there's a big deal. I believe actually they had in the US. I'm pretty confident of that. The Toys R Us deal, KKR got really, really hammered for the mistakes there. Yep. And, there's no one thing that it ends up sending a business under. It's a cumulative number of mistakes that sends a business down. And no industry is perfect. Not in any industry will they always get it right. And there's plenty of privately owned, not private equity backed. There's plenty of publicly owned businesses that have gone wrong, and that's going to happen. But yeah, I agree. Being as transparent as possible and being as understanding of that, and looking back at those mistakes. And I think sometimes firms that I speak to can be a little bit too hungry to deploy capital, and sometimes look for all the good in a deal rather than looking at selectively at what a deal would be. Not every firm, absolutely not. And I know a lot of firms that are very particular, but also there can be pressures to deploy capital because you've got your waves coming down, and you need to get that money out and get it deployed because your investors are going to want a return, and we're not waiting around for 20 years in the most part. We all aim for the 3 to 5, which usually ends up being 6 to 8 for most firms, for them to get that deployed. Just thinking about it from a news perspective, something you mentioned when you were on your last piece there, but looking at the industry as the individual firms and how good they are at, promoting both themselves and if we think of every I can't remember who it was that said it. It might have been Gary Vaynerchuk, obviously running a media company, but talking about how every company now has to be a media company. What's your kind of perception being if I, rightly or wrongly put you under a media type business being news, and I know you'll drive the data and everything and intelligence there rather than media, but if we put the news side, how do you feel that the private equity firms do with regards to the media element and the actual, presentation of themselves and promotion of both themselves and the industry?
Again, I mean, the progress that's been made is tremendous. When I joined, I remember a number of even quite pretty well-known firms, as in well-known in the industry. Have done a lot of deals. It's not not their first fund, etc. Their website was literally just a business card on the white empty background. There was a lot of that. There was a lot of we never talk to the press type responses as well when we call to inquire. And bearing in mind as well, we're unquote we tend to not focus on the negative. We're trade publication. We understand private equity. We know what makes it tick. We know how successful it can be. We're really not out there to do people wrong. But there was a lot of that just general lack of engagement, I think, which has massively changed. I don't think there might be a couple of firms that are still in that mindset a little bit, but especially 10 years later, a number of the firms that we cover now, obviously some of them were there when I joined, and the guys have been there for 20, even 30 years, but the number of firms that kind of either were created out of the blue in the past 10 years or, spin-offs, etc. They straight from the get-go, they never had that attitude. It's always been about explaining what it is you do, and trying to engage as much as possible, obviously on their own terms. And I think in general, what we tend to be after is of course, we want to tell, people's stories when it comes to, the story of a deal and what, how good they were at executing their strategy, etc. At the same time, we're always after kind of hard financial intel as well, and that sort of thing, and performance, and that can be, there's still a little bit off limit, so it requires a little bit more finessing. But in general, now I think people are just much better now. So what works, I think, is just thinking of it beyond just, it's something that needs to be done. And again, I mentioned that earlier about ESG as well. It's that kind of mentality where, it needs to be, let's tick that box, and we've got a new section on the site and we send out press releases, and that's it. And it needs to be beyond, because we do a fair bit of kind of thought leadership as well with people, either people kind of sponsoring our reports, but also we kind of sometimes work with them to put out, either they contribute to our reports or we publish Q&As with them, that sort of thing. And I think just moving beyond a marketing mindset, and it's the same from a news perspective as well. If you have when you send a press release, or if you have a chat with someone following up a press release, you've just announced a deal, people will want to know more than just, it's been amazing, fantastic management team, and it's great. And it's the same from a thought leadership perspective, right? It's not about your firm, it's not about you. And I think that's what people sometimes fail to, again, much better in the space of a few years, because people are just more savvy. The way firms now use LinkedIn, all that sort of thing. Social media in general is a bit, Twitter, private equity and Twitter is not a match made in heaven. VC a little bit better, but
those guys have got it much
doesn't work too well for private equity just yet. But certainly LinkedIn, I mean, the people have been better, and I think where it really works. And I remember you asked me before, when we chat before the recording, what kind of influences, et cetera, and I think the number of stuff that I read that's put out by firms, reports and thought pieces and surveys and stuff, it's great. And it's that kind of stuff that really, really works. And that's what will make you stand out, really, rather than just sending out press release, or inundating with press releases, or always offering the same person to talk on every single panel everywhere. It's just it needs to be a little bit more crafty than that, I think.
No, absolutely, and I completely agree. I think there's definitely been a development with regards to the look of firms. I agree.
Oh yeah.
Even 3 years ago, when I was looking at companies' websites, I mean, ours was probably a victim of that as well before we went through our rebrand. But firms that had been around for 15, 20, 30 plus years, and it literally looked like they were built. Mm-hmm. Pre-internet, obviously that's not even possible, but it was that, like, you look really, you don't even tell me what you do, you don't tell me about the value that you bring. Mm-hmm. And I think
massively important. Again, I mean, think about it from even a potential partner on the management side, judging from that angle. Obviously you will, if you're going to be serious about that deal, and you're going to talk to them, and you're going to spend some time with them, and you're going to give them everything they need to know. But the first thing they'll do is literally look you up, and if that doesn't look great, then it's a bit of a you're going to have to fight to overcome that, and then same from an LP perspective as well. And I think the reason GPs want to engage with us as well from a news point of view, from an analysis point of view, is because they know that our content will be read by LPs they might not necessarily know about yet, right? And especially smaller LPs, etc. And it's just having your name out there next to something that makes sense and is really shows what it is you do, without too much marketing guff. Albeit and you said that the website, they certainly do. You've got to go a little bit beyond just the way it looks as well, and it has to be about the content and the word and what you say about yourself, I think. But yeah, I mean, there's some great stuff. I was actually one of the UK mid-market firms that we tend to cover quite often. Sinova, I don't know how familiar you are with them.
Yep.
They've just gone through a fairly minor rebrand in terms of they're still named Sinova, but I was checking out their website and it just looks amazing. It's really, really good.
It's been a while
it looks really good. Nice pictures and a nice design, like a nice visual language there that just makes it, it's the, slightly almost VC-like in that approach. I think VCs have been obviously, occupational hazards have been probably better at it than traditional
investing in the tech world, I think, and the software explosion that we've seen and everything else. They kind of have to be.
It is important, and just being candid as well, and that's again in terms of the way that you present yourself and the interaction that you have, and mostly with the media. I think that the firms that really stand out for us is when we talk to someone who's not just there. Let's say we talk to someone for a piece about a specific trend within a sector or a deal type or something like that. It's people that just speak their mind, I think is important, because there is, I think, the flip side to people being much more professional and institutionalized in their approach to communication has been a slight kind of everyone's media trained. Everything is has to be approved 5 times before it gets out. Obviously it started with the big firms, and now it's starting to make its way down the value scale as well. And I think before we used to talk as a reporter. We used to talk, one-on-one with a partner, a small firm, very easily. We still do that, obviously, but everyone's just a little bit more kind of in the loop of the whole communication thing. And I think the risk you have there is just you just come across as being a bit too corporate and a bit too bland, and again, the more people do that, the less you stand out among that. So being quite frank, not outlandish, not provocative, just for the sake of it, but just being quite open again about what it is you do, how you do it, and what you see, where you see the market headed is very important.
Yeah, absolutely agree. So we talked about standing out, we talked about that media element, but what advice would you give in a very saturated market in private equity? There's a lot of cash, we've got a lot of competition, or at least we had a lot of cash on the market pre-COVID. There was lots of competition. We had high net worth investors, angel investors, all these crowdfunding things, more so probably VC than private equity. But what advice would you give them from your perspective to help private equity firms stand out more to their potential acquisition portfolio companies and potentially to LPs as well?
I think ultimately it comes back to what makes a firm successful, because I think that's what will make people want to engage with them, whether it be from a deal perspective, i.e., you're the vendor of a particular business or the management team of said business, but even from maybe a co-investment perspective with either the GPs or even LPs, and obviously, and that's the big one. I think that's the one that private equity will always have its eyes on. From an LP perspective, and people kind of there to back your next fund, essentially. It comes back to what makes them successful, and there's a couple of things that we've talked about before. And I think that the clear strategic focus, being again very, very clear about what it is you do, and having an angle is increasingly important, and that's how you stand out. I mean, and that's not new. That's not just a COVID thing, or it's a difficult market when you stand that sort of thing. It's been the case for at least 5 or 6 years. It's just a very saturated market, as you said. It's worse in certain geographies and certain segments than others. But the typical example I always have is just another mid-market fund in France, and there's so many of them, all around kind of roughly the same kind of size bracket for the deals they look at.
Very similar in Germany.
No real clear focus. No real clear focus as to what they're going to invest in. It's just literally, kind of anything that kind of looks good, which is, it worked, especially in the beginning, but I think more and more, and that's not saying they're not good at what they do. That's absolutely not the case. They can still do great deals and again, drive good value creation. We're really talking about perception more than anything here. And that's, that doesn't help you stand out. Whereas you look at other people that have managed to not necessarily even reinvent themselves, but kind of refine what it is they do and start targeting maybe 3-4 sectors kind of repeatedly, having a very clear tech angle. You look at even in the for larger firms, HG in particular, I think is something that people will look at as a good success story in that sense of being very sharp, laser focus on what it is they do and being very good at it. And that's and also that, again, that clear strategic focus in terms of how you're going to create that value beyond just the initial selection. So that's very important. The value creation capability we talked about, and being able to demonstrate that is obviously what's going to stand out. But something that we haven't really talked about is, and should be very, very important, is the people at the firm. And I think the whole private equity is a people business. It can be, I think, underestimated by some, or maybe even overestimated in some respect, in the sense that we've got our new, and that tends to be the case for kind of new firms that are maybe spin-offs of kind of older, more established businesses where the team will kind of split out. The managing partner, the founder, is that great mind and very good at what he does. They've been in the market for 20 years, 30 years. And it almost becomes very reliant on that and their interpersonal connections, and maybe ignoring the fact that a lot of the talent, will be kind of throughout the organization as well, all the way down to, and that's the beauty about private equity is, and I think that's what makes the best firms stand out, is that ability to attract the top talent at all the levels. And it's obviously very important to have a very personable, very sharp partner, real deal hunter, works really well with management teams, what have you. But, equally important to have someone in a data room that can analyze, that can take advantage of data, both from an origination perspective to kind of track deals and identify pockets of opportunity, but even within value creation for a business, the ability to harness data, much like it is in the rest of the business world. I mean, it's not a private equity thing. It is becoming increasingly important, and you need that talent. And it's, in general, it's having people that are very sharp, very good at what they do, and if possible, and we might talk about it a little bit later, don't all look the same and all sound the same and all think the same. And I think that's very important. And that, again, that can be a tendency, especially for smaller firms. And it used to be a tendency, but it's changing through generation change, etc. But that we're going to build a firm in our image kind of thing was quite prevalent. And if you didn't fit into that mold, if you really didn't have that same vibe and energy, didn't work out so well. I think having a bit more cognitive diversity across the firm is very good, and because then you can tailor who's going to be best suited to work on what, depending on what sector it is, what the management team looks like, etc. That's very important.
Yeah, I think there's a lot of firms, and there's well, maybe not so many now, but there's still some that come to my forefront of my mind when you say they're all the same. You can spot them. If there was a lineup of private equity investors, you'd be able to go, you look like you work for X firm, and having that kind of bit of personal identity. I've not come across a private equity firm yet that doesn't describe themselves as entrepreneurial, I'll say that in a little bit of jest and a little bit of truth as well. To be fair, that there's that we are very entrepreneurial, and again, comes down to that: how do you differentiate yourselves? Well, we're entrepreneurial. Yeah. Well, every private equity firm is. It's a bit like search. Well, we get you the best talent. Well, you all say that. How do you differentiate that and build a value creation, but value creation for the portfolio companies, for the people that you're going to be working with. Nicely coming on to talent there, Greg. My favorite subject for obvious reasons. What are the 3 attributes that you believe that make a top performer?
So you mean an individual within a firm?
Yeah.
Okay, that's a very good question, which actually, and that's more of an aside, if we do a cut later on to go back on. I thought you meant about a firm.
Well, if you want to do it about the firm, do it about the firm.
Which is what I've just been through with the people and it was my three things with people, strategic focus and then value creation capability. Do you know what I mean? I could try and think of something of the hoof for, kind of individuals.
We can leave that if you've not.
Do you mind if we
Yeah, absolutely, absolutely, no problem whatsoever. So we'll go on to. So what do you love about the private equity industry, and what do you hate about it? If hate's too strong, what do you dislike?
Slightly strong word, but yeah, I'm sure I'll find something. Look, I think what I love is probably what surprised me the most when I started covering it. So that actually goes back to me and my background. I don't come from a financial background at all. I started my career as a general journalist. If anything, I was writing about TV series and cars and test driving cars and that sort of thing. Right. So I'm not from that background at all. I studied political science. I did a fair bit of economics and stuff like that. But literally, when I joined Unquote, I had to learn about private equity from scratch. And, I remember seeing the first few headlines being like, what is this? Am I going to cover like derivatives and that sort of abstract financial stuff? I'm not sure about this at all. But literally within, 2 days, I had my first call, I think, with a partner, a firm that just did a deal. And he ended up talking to me 45 minutes about, I think, the way that the company that just invested in we're building, a replacement artificial heart and stuff like that. And it was just you could tell the passion behind it and the very kind of real world. I can relate to this aspect, and ever since, I mean, it's still, I think, what interests me the most in that industry. It's just so varied and so real world like. It's got implications for everything that you see around you, especially the more you're going to delve into what it means in terms of the LPGP chain and what that whole flow of capital and how it comes back to you and your pension and how it intersects with public pension funds on the other end of the world. It's mad stuff, but it's just very relatable stuff, and in turn it means that you deal with very relatable people. And that's what I think has kept me going in that market, is just talking to great people all the time. And they're just so interesting. And of course you'll get, your fair share of people are basically in it for the money and are a little bit more, kind of jaded and stuff. But by and large, it's not just, you talk to VCs, it's super interesting. You talk to a large cap buyout guy. It's absolutely not the case. Some of the partners at some of the bigger firms and the oldest firms, just so interesting to talk to, because that wealth of experience and just that natural curiosity, I think, and ability to connect with people, which I think is quite idiosyncratic to private equity, because it really wouldn't work even if you take the extreme example when I said about data harnessing and stuff like that, and how important it can be nowadays. Sure, it is, but you couldn't just run a private equity firm based on that, right? You need that human element, and I think that's what really interests me about private equity. It's just the wealth of rich people that you encounter in terms of their experience, in terms of their skill sets as well, because obviously, as you very well know, you can be a specialist in private equity, but most of the time people tend to, especially in smaller firm, tend to be very well-rounded. From one minute you could be crunching numbers, but then you've got to do some origination, go to a management meeting, you've got to understand, get down to the nitty-gritty of what makes a particular sector tick. It's great stuff, which is why people want to work in private equity beyond the pure money thing, right? It's just a very interesting pursuit. So that's still, that capacity to, and we add to that the capacity to evolve and adapt. I've talked about that before, but just the way that the industry has changed in the past 10 years, I genuinely love that. It's the fact that they now have a much keener eye on ESG, on technology, it's just going on with the times, which is great. On to what I hate. It's a very strong word, and there's not very much. I think that's disgusts me about private equity. I really don't like. But I think something that sometimes I think people could make, there's more room for improvement is certainly the lack of diversity, I think. And from all points of view, I'm not just talking about gender diversity. I'm also talking about racial diversity and diversity of background. And it's changing super rapidly, of course, because it's been a hot topic in the industry for a long time. Yeah. And people are making genuine efforts to try and tackle it. And I'm absolutely not saying that private equity is completely blind to that. But it's still, it's still a fairly non-diverse industry in general in terms of the workforce, and I think that can lead to a lack of cognitive diversity, which can lead to worse investment performance, and it's ultimately just not let's pay lip service to diversity and because it looks nice to have more diverse teams and things like that. It generally has implications in terms of performance, and I think that's not really up for debate anymore. There's been a lot of studies around that. And from anything from gender to the people's backgrounds will really, with the more diverse your firm is, the more likely you are to outperform. And I think there's and we're guilty as charged of maybe sometimes not trying to promote more diversity in the industry and try to talk to different people and give more people a voice, because that tends to be all the efforts that are made around that in private equity are certainly bearing fruit. And I think you can see the average, the proportion of, let's say, if we take just gender diversity, for instance, the breakdown between male and female kind of workforce within private equity has been kind of steadily climbing back up and reaching towards parity. But first of all, we're still some way off that in pure numbers. And also that's just headline numbers. And what that hides is a massive disparity between the investment teams and the back office, for instance, where the investment teams will be predominantly male and the back office will tend to be, that's where the parity will be much greater. And I think that's where more effort is going to be needed. It's obviously a very, it's not something that private equity as an industry can just click its finger and go, we're going to fix that. It stems with, first of all, people wanting a career in finance. It just goes well beyond private equity. Yeah. But that's definitely, I don't know how you guys think about this and how you approach it. And even if it's, you think that's an issue, but that's certainly something that I think is changing, but it could change maybe a bit quicker.
I absolutely agree, and I think it comes, and I think if you look at anything, I think it's a shame because it feels a little bit not forced is maybe not the right word, but it's also the correct word if that doesn't technically make any sense. But it's going about it to add value, not going about it because you want a female partner on your team. It's thinking about how that person can bring different skill sets. And we talk diversity a bit too much, I think, as the male-female split. And I think that comes from, I was watching, and I'm going to forget where it came from now. I think it was on Netflix, Unexplained, actually. And they were talking about, that was more focused on gender diversity, on the pay scale and the differences there. But the interesting element is that a lot of that comes down to the fundamentals of, and you touched on it there, is women going into finance, is people with different backgrounds going into that, and somebody who's not come from a typical background and wealthy environment and have come through, maybe different, maybe they've had a bit more hardship and had to fight their way through to get through to the right levels and grading and everything else to get into the top university, to get through to, in some parts with the bigger firms, you have to be in a top 3 investment bank or a management consulting firm to even be considered. I think there's looking outside of that track to be able to go, well, how do we bring value in? Because and it's an interesting thought, because I think a lot of the entrepreneurs that these people are buying firms from don't tend to come from the kind of similar route that they are that they've come from, and that's because it tends to be that, and I don't like the word entrepreneur because it's very overused, but especially in the lower middle market, I think large cap CEOs and everything tend to have more of that kind of track record. But in lower middle market, founder led businesses, they don't tend to have masters and MBAs and all this kind of stuff. They may have it later, but they didn't have it when they started the firm. And that tends to be that, there may be a little bit of lack of relationship building from there because you're trying to get people from it. But I understand that the financial modeling is incredibly complex, and I don't even want to begin to understand the complexity of that element. But I think there's an element of just general diversity, as well as bringing females in and different racial profiles and everything else that comes with it.
And I think hopefully, and going back to what works for firms and what a successful firms looks like, I think hopefully the people's increasing focus on tech, for instance, or just having more specialists around data, around different aspects of ultimately what goes into private equity and makes investment successful. Hopefully that will help as well, because you'll have to bring in, you won't have a choice. You'll need to bring in kind of different profiles
to work.
And not from that investment, not that investment banking molds. And because otherwise, and that's, which is good for the industry in a sense, because I think I was talking about, I think it was about a year ago, I did a big piece, I write about twice a year nowadays, but I did a big one around kind of generation change in private equity, and talking to recruiters and talking to, kind of more academic types and stuff, and GPs, obviously. And I think one of the consensus things here was, there's a real risk for private equity to miss out on talent, or even see talent draining away towards, to tech environment and tech firms for a variety of reasons. Any up to and including kind of culture and what, the purpose, sense of purpose, mission, et cetera. And I think that's, again, what makes private equity firms successful, much like, what makes any business successful, really, is that sense of that vision and that sense of purpose and that mission. And I think the better private equity is at kind of laying that out there. And, within the context of, obviously, it's going to vary greatly between different firms, right? But as, on an individual case-by-case basis, how that's going to work is really these firms going out there and say, this is what we do. This is how we do it. This is the purpose we have. This is how we serve the kind of the greater society. And it's not just, sure, you'll make hopefully lots of money, but it goes beyond that as well. And again, much progress has been made on that front, but that's surely something that will help kind of steer away people from going like, well, you know what, I'd rather go work for a different industry altogether that kind of values my values a little bit more. That's that type of stuff I think will become increasingly important.
No, couldn't agree more. And I think if we look at, and we shouldn't rest on this, but I think if we look at the venture industry, I think, I don't think private equity would thank me from an ego perspective that we look at the venture industry and we see what might happen or may happen in the private equity industry. Because I think the PE industry would like to say it's a leader. But if we look at the VC world and the change that's gone in there at a pretty rapid rate, I think that clearly demonstrates what will happen to the private equity industry as those firms are coming through that and those companies progress. We're going to have to look a little bit more like that as more and more venture money gets invested to those businesses. As capital becomes easily accessible, I think we're going to see less businesses scaling on what I regard as bootstrapped founder capital. There's going to be that injection of money, especially as we see a lot of digital world, which, can be difficult to scale on the owners built wealth in what can be, some of these owners are coming through and they're incredibly young and therefore they haven't had the time to build that money. So no, I think that could be a whole discussion point for itself, to be fair. And gender diversity podcast session would get some, or just diversity, sorry, not gender diversity, general diversity, I should say, would get there. So your influences, what is it you read? What is it you watch? What is it you listen to? Obviously, other than, I'm sure you don't read your own blog posts over and over again, but
I love love reading my articles. No, but actually, I was going to say, first and foremost, I read what my team puts out, and it's really important because, again, as I said, I've got less time these days, first of all, to write myself, i.e. to look into like what is so appealing about what it is we do in financial journalism, which is to look at a trend and kind of explore that, do a bit of investigative stuff on the news side. That's all very interesting. I haven't got the time to do that so much these days, but I absolutely love just seeing what we do. And I mean, we're part of a bigger group, and some of your readers some of your listeners, might be more familiar with firms like Merger Market and Debtwire and guys like that. We're all part of the Accurist family, and just seeing the wealth of knowledge and content that we've got across the group is absolutely brilliant. And literally, I wouldn't have enough time in any given year to read all the good stuff that we put out, from just news down to reports, and then kind of thought leadership and analysis and data, that kind of stuff. So that's what from a professional perspective, I think that's what I look at most. But I think, and again, I think I pointed to that earlier as well when we mentioned the way firms put themselves out there. I think the wealth of knowledge and resource that is now generated by the industry itself, and you guys are literally an example of doing that with this very podcast. Is that that kind of stuff? And obviously we receive a lot of that straight away, an unquote. There's just some great stuff out there, from quarterly reports, barometers, the color stuff that Color puts out, Color Capital puts out is great. The slightly lesser known perhaps firm, a placement agent called Triago, to do their Triago quarterly thing every quarter. It's really interesting, like round table with a few different people, and they've got really access to really good data. So that's definitely worth checking out. And all the way down to even outside of the industry. We've actually, for the past few years, we've been working more and more because of one of our events in particular, which is a bit more kind of forward looking, and let's look outside just the private equity bubble and look at the deeper trends and the macro stuff. We've been working with some really great people that put out their own content. It's an institute called the Post-Lean Institute in the US, which is absolutely amazing when it comes to understanding the change that businesses have to go through at the moment when it comes to their workforce, when it comes to their strategy. It's absolutely amazing. And Frode Odegaard there does a lot of really thought-provoking stuff. So I'll read most of that stuff, and then after hours, unfortunately, don't have infinite time, and I've got a small child, so I tend to kind of switch off PE mode fairly quickly when the day's over. But I'll listen to your podcast, and I think perhaps closer to what it is we do. But and that's not going to be a very original answer, I'm afraid. But a big fan of This American Life and Freakonomics, that sort of long form, really engaging stories. I think is superb, and we could probably do a little bit more of that in a private equity setting almost, when it comes to our own podcast and our own content. Slightly lesser known, but especially in the past sort of year or so, I've been delving into Philosophize This, which is a fairly good podcast to sort of democratize philosophy, and in particular kind of political philosophy. Well, actually, I went back all the way to the beginning to like proper, Greek philosophy. It's someone going through the concepts, and usually it's focusing every time on one thinker or their school of thought. And it's especially in these times, I think it's quite nice to go back to that sort of, let's look at the bigger picture sort of thing. Yeah. It's very important. I certainly recommend that. And then it tends to be more on the fun side of things. So it'll be the odd Joe Rogan experience. I'm a big fan of mixed martial arts, and practice martial arts myself. So Heavy Hands is a really good kind of very analytical, very geeky podcast about that particular sport, which I really like. And after that, it's really reading too much news, and I tend to do that less and less because it really drives you crazy, especially
now.
But yeah, I had a phase of
difficult.
Especially reading, and when I say news, it's news and kind of analysis around it, which again, I said good journalism in general is a fairly big influence for me, and even kind of seeing what people write about and how to write about it when it comes to news, I try and take away from that to kind of so that we can work on something similar for Unquote. But yeah, no, reading too much news, especially around the US elections and then Brexit and stuff, it's just, it tends to drive you mad a little bit. So I have to, again, take a break and I'll watch a series and or watch a film and that's that.
No, absolutely. I'm the same. I'm not one for the news. I try and avoid it, especially at the moment. It's all doom and gloom and everything. The world is over. So I get that. What advice would you give to your 20-year-old self, Greg?
Probably stop smoking and exercise
good
more.
Advice.
And exercise more. Because Jesus Christ, you don't think about that when you're 20. But no, you don't. And eat less crap. But more seriously, I think cram as much knowledge as possible while you can, and that might sound a bit trite, but I mean professionally, culturally, kind of even when it comes to your hobbies and stuff like that, I think there's only so much. I don't know how you feel about that, and I'm not even. I'm 35, so I'm not complaining about my age by any stretch. But there's only so much your brain can absorb, I think, later in life, which is it sort of gets filled up and overtaken by other things, and I think I probably missed out on the opportunities to gain more knowledge, deepen my knowledge in certain areas, while you've got the free time and just I think the headspace is very important. So that would be my one piece of advice. I think just be more curious and learn more.
Yeah, I'd agree with that. It's amazing how when we go through our education and it's forced down us to a certain extent, and then as we kind of come out, and then it's amazing how thirsty for knowledge we become, and that kind of switch just kind of happens, and it's a shame that maybe there is. Not saying
you can't do it now, and I think
Well, no, you can. It's just life gets in the way. You've got a full-time job. You aren't just going to school and finishing at 3:00 or whatever, and then going home and watching rubbish or nowadays I'm assuming kids just spend all the time on YouTube and consoles and phones. But it's you've got a kid, so therefore that obviously takes take the time. That's not the right frame, but it obviously means you don't have that ability maybe that you would have had when you were younger to do that. So I think that's great. Well, look, Greg, I think you've given us a lot of value here, and I really appreciate everything you've shared. If anybody wants to reach out to you, obviously you are a news outlet, so I'm sure you're hungry for information, albeit in a let's not see this as I think the news also outlets get a bit of a negative. Let's find bad stuff out. You guys want to hear about the good and the, I'll put it as the interesting. So if anybody wants to reach out to you on that basis, or just generally to maybe have a chat about your podcast, the podcast that you guys run, but also the philosophy, if I can say it, philosophy side that you've been studying and listening to. I'm sure there's a few philosophers out there. How best do they reach out to you?
So first of all, first port of call is unquote.com, where people can sort of check out all our content. I mean, it's paywalled for the most part, but people can see what it is we do, and more importantly, get in touch with us that way as well. So Eddie, if any of your listeners are active in the European private equity space or want to know more about it, want to kind of engage with us on that basis, more than happy for them to get in touch there. I'm on LinkedIn, the Tim's on LinkedIn, so it's fairly easy to find us there as well. We're on Twitter, and as you mentioned, we've got our podcast as well, which is called the Unquote Private Equity Podcast, which pretty much does what it says on the tin, and comes out every couple of weeks on the usual platforms. So yeah, more than happy to engage with your audience, and we're more than happy to explain what it is we do in more detail and show people what intelligence and data we have on the European private equity space.
Brilliant. Well, we'll pop all of that in the show notes. So if you do need anything finding guys, you can also find it in the show notes. We'll put all the web links and LinkedIn profiles and everything else in there. So look, thank you very much for joining us, Greg. I really appreciate your insight. It's been great.
Absolute pleasure. Sorry about the slightly rambling answers at time.
No, absolutely love it. It's
massively overshot the time limit. But thank you very much.
We have done, but value cannot be. You cannot put a time on value, Greg. So I appreciate that. So as always, thank you for our listeners for joining us. Should you ever need support with private equity professionals or portfolio executive hires, please do reach out to me at Raw Selection. But if you need to and you've really enjoyed this, please do subscribe and you'll be notified of our next podcast. But till next time, keep smashing it. Thank you.
Thank you for listening to the Private Equity Podcast on www.raw-selection.com.